So our parents taught us to sell high and buy higher. They didn't teach us to sell high and buy higher 180 days later from now on a property that you didn't want to buy anyways, but you feel trapped because of the tax. So what we're solving for is this capital gains tax. And the question is, what's the best solution, right, to unlock what's truly meaningful for you, Harley, or for whoever the listener is?
Welcome back to the Scale Smart, Grow Fast podcast. Today we have a really special guest, Brett Swarts, who's going to share a lot of really important information about tax strategies. And I think it's going to be really useful information for all of you business leaders out there. Now, most entrepreneurs don't build a business just to hand their profits over to the IRS. Scaling your business should go hand in hand with scaling your wealth. And one of the fastest ways to accelerate both is by protecting your gains from unnecessary taxes. In this episode, Brett Swarts, founder of Capital Gains Tax Solutions and host of the Build It to Billions, breaks down tools like Deferred Sales Trust, Delaware Statutory Trust, and 1031 exchanges. It's going to help you keep more of what you've earned, delegate smarter, and generate truly passive income. Whether you're in real estate, crypto, or building your next big exit, this conversation is going to change the way you think about long-term wealth. Brett, thank you for being on the podcast. How are you?
Harley Green, better than I deserve. Thank you for having me. I'm grateful to be here. I like your name, by the way. Harley's just a cool name.
Awesome. Thank you. It's a family name, great-grandfathers. Well, Brett, tell me a little bit more about your background, kind of what has brought you here to helping other entrepreneurs and professionals with saving on their taxes.
Yeah, so it starts out when I was young and I was learning about real estate and business in California, my mom and my dad building houses. And this is the 80s, 90s, and fell in love with real estate and entrepreneurship and building something from scratch. And we had a lot of success in the beginning. The family did. And then the family also had some pain as it pertains to wealth and some pain as it pertains to divorce. And I remember at a young age thinking, I'd like to make wealth in a way and have finances in a way it doesn't, separate the family, And so that was instilled in me at kind of a young age. And my brother was the first to graduate college. I was the second. And I then started to study and practice multifamily brokerage at a place called Marcus and Millichap. And I learned about investment real estate and underwriting and cap rates and value add and all of that. And that was really cool. And it's kind of like, you're kind of like a mini entrepreneur because it's 100% commission inside of a brokerage, learning from some of the best in the business. And that was great for a little while until the market crashed. And then went from making a little bit to like nothing overnight. And if you've ever been in that spot, entrepreneur just trying to make it in the world, that's where I was. And so I found myself, asking my wife to please allow the family to move with my brother to his small condo with our first baby on the way. And, I had to be really humble and still work at Marcus and Millichap by day to negotiate with banks. And then by night I'd work at Cheesecake Factory and serve tables. And so I did that for like a 2-year stint. But during this journey of financial challenge, really clarified and really planted the seed for the calling that we're at today, which is to unlock capital gains to multiply freedom and impact. You see, why I was going through this pain of our financial struggle as a young married couple, my clients were losing half or all of their wealth in the great, financial recession because they had overpaid for property. They had too much debt, not enough liquidity or diversification. And it was really sad to see. And I found myself like a front row seats in the middle of, the banks, the owners of properties, working with buyers, helping them renegotiate their taxes or tax assessments. And so we said, there's got to be a better way than just getting stuck when the musical chair stops and the 1031 puts you in a tough position. And there is, and we figured it out. And it's called a Deferred Sales Trust. We'll dive into it now. And basically it gives the ability to not have to suffer the consequences of a shotgun wedding with a 1031 or having to stay in debt or having been over concentrated. It gives total freedom for the entrepreneur. It's the best thing for the entrepreneur. And so our passion is to really share this information with those that are, by the way, works for business sales, it works for Bitcoin, works for real estate, so that they don't have to suffer the consequences like a lot of my clients did. And they have the freedom to pursue the things they want to pursue, whether they want to be retired and truly passive or whether they want to be an entrepreneur and be active. The Deferred Sales Trust can be a great solution for them.
For those that are listening that maybe aren't familiar with like the 1031 exchange concept, can you give like a really high level overview of that? And then why it has some of these difficulties that the Deferred Sales Trust addresses?
Yeah, the 1031 exchange is basically a continuity trade strategy where I'm trading my piece of real estate for the next piece of real estate. Now, technically, you're selling, and there's actually a way you can actually trade. Most people don't do the trade version, but you're selling your 15-unit apartment complex and you're buying an 80-unit apartment complex. You're selling your commercial office building, medical office building, and you're buying an industrial real estate property. You're all within the same food group of investment real estate. It has to be investment investment, cannot be a primary home, whereas the deferred sales trust can be a primary home. And you're just simply buying the next property and you're rolling all of the proceeds into the next property. You're also replacing at least the amount of debt in which you sold for, which is the Achilles heel for a lot of these things to sink the ship, with interest rates doubling in the past couple of years here. And essentially you have to do that with a short time frame, right? So our parents taught us to sell high and buy higher. They didn't teach us to sell high and buy higher 180 days later from now on a property that you didn't want to buy anyways, but you feel trapped because of the tax. So what we're solving for is this capital gains tax. And the question is, what's the best solution, right, to unlock what's truly meaningful for you, Harley, or for whoever the listener is? And that's where the 1031 exchange can actually be an amazing thing, because if you find the right deal, the right time, boom, you get to compound the deferral, you get to roll it into the next property, you keep rolling your money. And so it's not that we don't love 1031s. We in fact, we love them. But when we want to buy the deal and not vice versa, right? So we want to be able to use the hammer of a 1031 when the nail is just really ripe and we can hit it perfect, right? But when we need a screwdriver or we need something else, well, that's not when we want to use a hammer, right? And that's when you're going to hurt your thumb and, be sore. And so that's the whole point. We want to give people solutions. By the way, you can do both. You can do a partial 1031 exchange. You can do a partial deferred sales trust. You can diversify a little bit. So it's not always a one size fits all. And that's the dynamic we want to bring to people, to give them the empowerment of both strategies or one or the other, depending on what's the good fit for them.
Yeah, I love that explanation. We've personally used 1031 exchanges, and sometimes they've worked really great. Other times you get like you're kind of in a corner running on that timeline. And oftentimes when it's a great time to sell, doesn't mean it's necessarily a good time to buy, and vice versa. So really excited to hear more. What are the details, and how would you explain to people at a high level, what is a deferred sales trust? How is it different from a 1031 exchange? And when is an appropriate time to use that tool you mentioned?
Yeah, let's do actually some real case studies. Just kind of bring it all to life here, okay? So I'm going to talk about Jeff Joaquin. He's on my YouTube channel. He's a client of mine. If you've ever driven down anywhere in California, you see these digital billboards, these beautiful digital billboards that are incredible. If you're in Sacramento, that's where I'm originally from. You go to the Golden One Arena. It's where the Sacramento Kings play. They have these massive, massive digital billboards. Well, those are all his, okay? So he sold a portion of his company for about $17 million. Okay, he had huge capital gains taxes. Now realize, when you're in the business, first of all, the 1031 exchange does not qualify for business sales. Guess what we do? We qualify for business sales. So he was able to sell, and he was able to defer all the capital gains taxes, number one. Number two, the 1031 exchange does not allow you to go into unlike assets. So you can't sell real estate and go into NVIDIA stock or go into Bitcoin or go into real estate debt. You can't do that. But in our strategy, you can go to all those things. So we sold, the business sold, deferred all the tax. In fact, he went into NVIDIA stock a couple of years ago, and guess where that stock went? Through the roof, right? The trust went into that investment. And so the point is, sell high, buy low, ideally for the different investments, right? At different times, dollar cost average. So we can dollar cost average. We have no 45-day 180 time frame, right? We can actually get out of debt. He was able to get out of all of his debt. Whereas in 1031, had he had to do a 1031, or could he even do a 1031, he would have went into debt. A lot of what's happening for the people who are hurting right now is their debt is resetting, right? They had these teaser rates for a couple of years, and now they're doubling in interest rate, and it's sinking the ship. And so what we teach is the method of, the mistake is going in 1031 and going overpaying, but the mindset shift is having a tax flow, cash flow, and debt flow mindset. And it's like seeing in 3D. And when you look at that, you say, when the market's really hot and overinflated, right? That's a great time to get out of debt, to get your chips on the sidelines. You can sit in money market accounts. The money goes to Schwab. We can sit and so we shifted, and we went into a lot of private debt with a lot of our clients because interest rates started to go up. So we were able to get these good returns. And then fast forward, now the market's shifting and we're seeing some good real estate opportunities. Guess what? The trust can now turn around and buy those investments, all tax deferred, the way we structure it. So you get in the concept here. Concept is Netflix versus Blockbuster. You don't have to show up and return the video in 3 days, the 45, 180. You can, there's some ongoing fees. You work with the trustee, that's us, right? But we unlock massive, massive ways to invest when it's optimal versus when it's less optimal. So that's the basis of it. I would say the other things you would consider as well, we could reset a depreciation schedule, which is powerful. Which you can get about 80% of it. The other thing you can do is you can sell Bitcoin and go buy real estate, and you can sell business and go buy Bitcoin, and vice versa, in and out. We've done multiple exits like that. You can do it for land entitlement sales. We're doing a lot of those right now, where people actually don't own the land, they own the contract, or they tie up a deal, then they do a double close. And we put that in there, even though it's less than a year hold. Like, that's a dynamic way we can talk about this. But really, if you're listening, we got to figure out, what are you trying to do, right? You're selling that business, you're selling that Bitcoin, you're selling that real estate. Do you have $1 million plus gain? And now you're looking for a flexible solution to build some wealth. That's where our clients thrive.
I love what you mentioned of like going from different asset types, because a lot of people, they like to have a balanced portfolio, but oftentimes they might have a real lopsided portfolio just because of market conditions, right? If you've invested in real estate over like COVID, that blew up, and maybe your portfolio was really heavy there. And with the 1031 exchanges, you can't rebalance into stocks or crypto or other asset classes. But it sounds like that is possible with doing the deferred sales trust.
Precisely. Exactly right. And that's what we've been taking advantage of with our clients, is just common sense investing based upon the fundamentals of each market in each asset class, bringing in amazing professionals. We work with the financial advisors for the securities piece. We work with some of the best real estate, private equity, and debt groups. And then, we have clients that are really smart in crypto and Bitcoin, and they know what they're already doing. So we figure that out. They kind of figure it out, but it's a team. It's a team approach, right? So it's not a one size fits all. It's customized. Exactly right, Harley.
Now, many founders are so busy scaling their businesses that they don't even realize these tax saving tools exist until it's too late. At what point should these entrepreneurs start thinking about tax strategy? And when does it make sense to start handing off that research to a team like yours?
Yeah, great question. So when it comes to your massive big exit, it's never too early, honestly, to start thinking about capital gains tax planning, right? Because you think about this, it's 20 to 50% of your proceeds are going to be crushed with tax, depending on the state you live on, the depreciation recapture, S Corp, C Corp, all these different things, but at least 20 minimum, but as high as like 50%. And so the question for us, Harley, would be like, if we knew today that if I started a company and I was going to build it to 10, 20, $100 million, that at least 20 to 50% would be gone. What did I want at closing of everything I built, blood, sweat, and tears? I'd want to plan now. And so actually we wrote a book on it called Building a Capital Gains Tax Exit Plan. And so you might build your business for 10, 20, 30 years, 5 years, 2 years, whatever, right? Blood, sweat, and tears. But if you spent 5 hours with us, you'll have an extra 20 to 50% working for you for as long as you want. And your kids can continue to make it work for you too. So we call it Building a Capital Gains Tax Exit Plan. And here's the cool thing. It doesn't take that long. I mean, we can build these things in about 5 hours, right? Max. And that includes talking with the clients, talking with the attorneys. We also do it on a conditional basis. So I think there's no excuse. Like, you just jump on with us. And even if you're like, I'm a year or two out, cool. At least do some little bit of planning. And so to this point, when is it too late is a good way to think about it. Mm-hmm. It's too late when the deal is already closed, it's over. The buyer has removed all contingencies, it's over. The other thing you have to realize is when these big M&A business brokers and attorneys get involved, I mean, there's a lot of moving parts to these deals. So you don't want to be, rushing something last minute. Have we done deals in 21 days? Yes, but we don't recommend it. We encourage you to really take your time, understand who we are, how it works, work with your team. Sometimes people don't have the best business brokers or commercial brokers or luxury realtors or M&A attorneys. Guess what? We have a network of the best in the country that we can refer, or maybe you do too, Harley, right? And so it's a good thing to spend some time planning, and it's never too early, but it can be too late.
What kind of threshold for like an exit, whether it's real estate, crypto, a business, typically sees the biggest benefit from setting up something like this with your team? Is there kind of a minimum? Is there a particular market or industry where it just doesn't make sense?
Great question. So I'll answer the second one first, okay? So any asset of any kind. So it can be artwork, it can be collectibles, it can be a dentist practice sale. We did a $16 million dentist sale out of Oregon. It can be land entitlement flipping. It can be Bitcoin. It can be public or private stock. It can be primary home. We did a luxury primary home out of Palo Alto, $8 million. It can be really any asset of any kind, as long as it's subject to U.S. capital gains tax and it has at least a $1 million net proceeds, $1 million gain. The Deferred Sales Trust works for all of that. The time it doesn't work great or it's not great is if and when the seller, the business or the asset needs or wants all of the income or all of the capital all at once to go spend on their personal primary home or their new Cybertruck or whatever, right? Like if they want to be consuming and spending it and not investing it, then it's not great. Now, who does it work amazing for? The entrepreneur who wants to have seed capital for the next business venture. We had a client, she sold 5 million of Bitcoin when she bought for next to zero. It went to 50 million of Bitcoin, and we sold 5 of it at 54,000 a coin. And she used 4 of the 5 million for a seed capital for like an online Khan Academy, right? And so we found that having a clear vision of where you want to go with the capital is just as important as the tax deferral strategy. And then having the flexibility to be able to navigate within the ecosystem of our capital gains tax solutions is really the secret sauce here, right? So have a clear vision, and then you can literally use it to buy your next Airbnb property, or to buy a next multifamily property, or your fix and flip. It can be the funding source. We had another client, he sold a $3 million business in Alabama, and he used a lot of the portion, deferred all the tax, to build 24 townhomes in Tennessee using the trust. It's all tax deferred. Okay. So that's what I'm saying. No timing restrictions, development. So it's really open source, Harley. But we'll sit down with people. We always make sure we're never talking people into anything. We just say, hey, here's your pros and cons, and here's your option A and option B. What would you like to do? But those are the folks that really fit well for us.
Every day, your top performers are buried under emails, scheduling, and reporting. Work that doesn't move the needle. The result? Frustration, burnout, and worst of all, lost revenue. That's why we created the Executive's Guide to Scaling High Performers, a simple, battle-tested framework to eliminate busy work and unlock your team's full potential. Inside, you'll get the exact steps top executives use to retain A players, boost productivity, and free up their team for high-impact work. Stop losing revenue. Go to workergenics.com/growthhub or check the episode notes to download the Executive's Guide to Scaling High Performers now. Now, earlier on in the episode, you kind of alluded to there's a potential for doing like combinations of these different tools. Like if someone's selling some luxury real estate, it could be like a partial 1031 and still have some use for the deferred sales trust. Can you maybe, without getting like too technical in the weeds here, like what kind of example scenarios might that make sense for using different tools in this scenario?
Great question. So the first thing we always say to folks is that, what do you want, right? And when they say, hey, most of them say, I want truly passive income, right? Like we've been taught, rich dad, poor dad, get into the quadrant. And too often, I think for those, especially who have made it to that 2, 3, 4, 5, $10 million mark in their real estate appreciation and assets, like they're ready now to unlock what they've always wanted, which is that bottom right quadrant, which is basically their money is working for them and they no longer have any toilets, trash, termites, tenants, anything, right? Like I call it the no shoes, no shirt, no problem. You're Kenny Chesney, Harley, you're sitting on the beach, you got no shirt, you got your glasses on, you got your cowboy hat, and you got your chair and you're just playing your guitar and you don't even think about it. You have this passive income just showing up every month, 20,000, 30,000, 40,000, whatever the amount is, just showing up. What is your number? So get very clear on your number. And then basically we reverse engineer it and we say, if we could defer your capital gains taxes and get you 10 to 12% net of our fees and this recurring basis, or you just can sit back and they're like, sign me up. They can't wait to get there, right? But they don't realize that most of what they're doing in real estate equity is tied to, 5 to 7% returns, which is not going to get them there. But if we can get 10, 12, 13% returns, all of a sudden we can accelerate that truly passive income number. Plus we can sell for them today. And so what we say is truly passive income is to your freedom and impact as compounding interest is to your money. Okay. So we start there. Now to answer your question, well, we got to figure out which tools are going to get us to where we're going to get, right? Is it the screwdriver? Is it the hammer? And so there are times where we're using a partial 1031 via a Delaware Statutory Trust, which is like the Hollywood video to the blockbuster 1031. It's just another form of a 1031. We're replacing some debt over a basis. This is a challenge for the Deferred Sales Trust. We cannot defer debt over basis. So we need to replace that. So watch this. We have what's called the best 1031 exit plan. Where step one, you sell the asset and you move it into the best 1031 exit plan with us. We have our QI company all lined up to go. And then we say, hey, Harley, how much debt is over your basis? You go, it's 1 million. Let's say you sold a $5 million asset that had zero basis and you had 1 million of debt. You say, great, we need to replace that 1 million of debt, Harley. You say, okay, how do we do that? About a $200,000, about 20% down payment is going to replace that debt. So we put that into a Delaware Statutory Trust and the debt is out of your name. It's like an Amazon warehouse, like big property typically, and the debt is gone. And then what happens is the 4.8 million, or in this scenario, it would be a 3.8 million, right? That's left over, right? Would be able to go into the Deferred Sales Trust. And you're like, oh, this is awesome, right? So let's just imagine you had a $5 million asset. And let's just say you had a 5% ROE. That's $250,000. But you had some debt on it. So let's call it another 50,000 of debt. So you were making about like 200K on 500,000, right? Well, now on this 3.8 million, We put you into something that's making 10%. That's $380,000. Okay. So we basically doubled your cash on cash return. No more toilets, trash, termites, no more debt. Okay. We did a partial Delaware 1031 and the rest of it can go into the Deferred Sales Trust. And you're like, and I don't have to do anything for you anymore. You're like, no, you did a good job, Harley. You can retire. And you might say, well, Brett, I'm still an entrepreneur. Great. Then why do you want to partner with the trust to go do your next venture? But you might want to do that in 3 or 6, 12 months. I have some clients that have kids at the young age. And they're like, I've got 8 summers left. They're 10 years old. I got 8 summers left before they're gone. For these next 8 summers, I like to maybe not have to be worried about these toilets, trash, termites, and all this stuff. After those 8 summers, man, let's go for it. Let's go build this real estate empire again. And by the way, the trust is ready to go with you on that. You can partner with it. Like your mind starts to just explode, like the possibilities. And that's what we're really trying to share with everybody. This is Netflix. It's totally flexible. It can adjust with your lifestyle. But sometimes it takes a little bit of 2 strategies to get you first there because we got to replace that debt. Does that answer your question, Harley?
Absolutely. The next question that comes to mind is, I know a lot of real estate investors out there, they get into it. They're all about the doors, right? I want to get to 100 doors, then I can retire. And it's kind of an odd metric, but if they have the 100 doors, maybe they're small doors. Can they combine those? And if they're like, say, I'm done with the tenants, trash, and termites, want to have that relaxed lifestyle and freedom. If they were like, just sell that whole lot and get to that, 1 million net proceeds, would that still work? Or does like individual asset have to hit that 1 million threshold?
It's a great question. So generally we like to say it's $1 million net proceeds, $1 million gain per property or per transaction, right? So if you had, 35 homes that all add up to $1 million, it's not a good fit. There's legal cost of about 1.5% of the gross sales price, one-time fee on the first million, 1.25 on the above. And there's ongoing trustee costs. That's us. It's about 1.5 to 2% on the net proceeds. So what happens is you have these costs. And so the pain and the legal costs have to make sense. So now, let's say you had 100 houses that collectively are worth $5 million and you could sell them all at once in one big tranche, right? And we can set up one trust and it could receive it. I could see that working. Yeah, but generally speaking, people have a lot of those houses, if the values aren't big. One exception to this, okay? We do one exception where if you had, let's say 2 houses at 500,000 each in gain and net proceeds, you can combine those 2 into 1. That feels good, but that's like the bottom of the bottom. We're not really seeking out those deals because we work on a conditional basis, and it's actually simple to set up, but it has some complexities, right? That's what I would say to that, Harley.
Yeah, that makes a lot of sense. And this kind of discussion is something that's really important for investors and entrepreneurs when they're getting started to think about the exit strategy before you start a new investment strategy. Because if someone is going after the small, 100 door strategy at $300 a month from each one, that might make it difficult to get to that living on a beach situation because you're still got all those tenants, trash, and termites to have to deal with. So really good insight you had there. Now, maybe you can talk about some of the misconceptions that investors or entrepreneurs have about capital gains tax deferral that might be holding them back from exploring options like what you have.
Yes, great question, Harley. First one is like, if my CPA doesn't know about it, then maybe it's too good to be true, or maybe it's not legal, or whatever the thing is. I think that the biggest mistake people make is they think their family practitioner who's done their blood work for 10 years and has helped them with their flu shots is the same person who did ACL surgery on their knee when they bled out playing basketball. I played basketball growing up in college and stuff. I remember blowing my ACL out and going to the doctor, and he was my family practitioner. Nice guy, smart guy. He did the little knee test, Harley, where he like grabbed the knee. I don't know if you've seen this, and they test the ACL. Mm-hmm. He kind of like, you're good. Oh, okay, doc, that's great. That's awesome. Trust him, right? Cool. He's my doctor. My brother goes, you should go back and just ask for the MRI. Have him write it up, have him go get the MRI, because I heard horror stories where people come back and the ACL was told it was good, but they didn't get the MRI and they blew it out and they're gone, done for their career. So I go back to the doctor. Doctor, I really like to get an MRI. You're wasting your time, Brett. You're wasting your time. Well, just in case, doctor, I don't know, probably waste my time. He's shaking his head. He's writing up the prescription. You're going to drive down there. It's going to take a couple hours. Okay, doctor. Well, thank you so much. You're generous. Let me deal with that. Thank you. I'm walking down there kind of sheepish. Well, 2 weeks later, go get the MRI. And I'm all excited because I'm like, doc, I'm telling I just signed a scholarship. I'm like, I signed a scholarship. I'm coming back. Maybe, yeah. Doctor says I'm good. I'm all excited. I'm going to be starting guard at the team. Like my dream come true. 2 weeks later, I get the call. It's my doctor. Hey, Brett. And he's like stone cold Steve Austin. Like he did no emotion. Yeah, the results came in. Oh, yeah, great. Well, how did they come out? What happened, doc? You have a completely ruptured ACL and you'll need surgery. That's it. Stone Cold Steve Austin, no emotion, no apology, nothing. And I'm devastated. I hang up the phone, like I start crying because I'm like, no, this is my dream to play basketball, don't know what to do. My team's practicing in the background. I'm like lifting weights and shooting on the sideline. I'm like, now I got to meet with the whole team and tell them. And it's devastating, right? So my point of all that is like your CPA, your family practitioner, just because he doesn't know about it or he thinks he knows, like it's your money. You're literally going to pay 20 to 50%. And so the worst mistake that people can make is to realize that you don't replace the CPA, you actually add a CPA. So my business partner is a CPA and a tax attorney. Thousands of transactions, billions and billions and billions of assets sold using the Deferred Sales Trust. Close to over 30 years. Been over like 30 no change audits, no change, no findings. Like we're batting 1,000. Like every time we get to the plate with an audit, we hit a grand slam. Perfect. And so what we're saying is trust your CPA. However, verify that he actually is the right person to do the ACL test, right? And he's not. Go get the MRI. Come with us, sit down. And here's the reality. Like, once they do, most of them join us. The challenge becomes the person like you, Harley, takes it to them last minute during tax season, and it's this rush thing, and they're like, oh, so it's not so much. I don't want to paint the picture of the CPAs or the bad people. They just want to protect you. They've never heard of it. They don't know. They don't know what they don't know, right? But so that's what I would say. That's the biggest thing. The biggest myth is that like my CPA needs to know about it for it to be, legal or good. But they don't. A lot of them just don't have the time. The tax code is 10,000 pages. They can't possibly, know how to do every single surgery, but ours does, and it becomes a part of your team. There's lifetime audit defense built in, and they're batting 1,000 so far. So far, so good.
That's awesome. Now, so we kind of wrap up for entrepreneurs that are listening right now who've never heard of this. What's the first move they should take after listening to this episode?
Yeah. So the first thing you should do, I think, is clarify your family mission, vision, values for your wealth. Right. And look at like today, are you living where you want to be, with your business, with your real estate, with your holdings? And are you wanting and sensing you want truly passive income? And do you have a plan in place to go from A to B? What's holding you back, and get very, very clear on that. And then figure out what's holding you back, and then you get unstuck. And so it might mean selling that business, selling that real estate, selling that Bitcoin, so, whatever it is, and having a plan for that cash to land in an efficient way that allows you to just collect truly passive income. Like that could be you. It could also be like, hey, you got a partnership, with the business and you want to go your separate ways, but you can't make sense of it. Well, our trust can do 2 trusts each partner and you can be separate, right? That happens all the time. It could be that you just have cash right now and you want to invest and you're like, hey, how do I get these 10 or 12, 13% returns? You might want to talk to me about that. Like these are all the things I think you should be asking yourself. And then here's the key. Then you get laser focus on only doing that one thing. One of the biggest mistakes people make is they try to get 7 different income streams all at once. There's a myth or I think just a mistake that people make is they're chasing all of these rabbits and they're just getting, they have diluted focus, so they get diluted results. I've had to train myself on this. And instead of chasing 7 different income streams, like get really good at one big income stream and get really good at one big investment vehicle, right? And then go all in on that as it pertains to unlocking your vision for your life right now, right? And so what that looks like for me is like we have one that's paying 16% right now. We negotiated, right? Where we're putting $500,000 in the next 4 years, paying about 16%. It's quarterly payout, net, it ends up being about, 25,000 per quarter. It's the way you break it down. That's basically our truly passive income number. Yeah. So I can be Kenny Chesney in 2 years, Lord willing, right? If we just did that. That doesn't mean we stop doing what we're doing. But everything we do after that is like a massive way to give and make an impact for MVPs and like have tons of margin. But if I don't focus like a laser on getting that done, it's almost like, like Dave Ramsey's debt snowballs. Like if you don't just first get out of that debt that's holding you back and you don't get momentum on that, it's very difficult to get the other things going. And so that would be my encouragement for all of the entrepreneurs and investors out there.
Awesome. Now, Brett, if people want to continue the conversation with you, what's the best way for people to get in touch?
Yeah, so 2 ways. Number one, you can pick up the book, Building a Capital Gains Tax Exit Plan. It's on Amazon, but you can also go to our website, capitalgainstaxsolutions.com, where you can see it there. We also have a free ebook there that you could download on the steps to setting up a Deferred Sales Trust. If you have a live deal of $1 million net proceeds, $1 million gain on a business, Bitcoin, real estate, or stock, or anything else that's highly appreciated, also go to capitalgainstaxsolutions.com. You can schedule time with one of my team members, and we'll take it from there. I have brettswarts.com if you want to follow me on Instagram and my travels around the world with the family and the different things we're doing. That's brettswarts.com.
Awesome. So, for those of you who have been watching this episode, if you got value from this episode, do one quick thing. Hit like and subscribe so you don't miss future strategies to help you scale smarter. And do you know a business owner or a colleague who could use this? Share the episode with them. It could be exactly what they need right now. And if you're listening on a podcast platform, leave us a quick rating. It helps us reach more leaders just like you. Thanks for tuning in, and we'll see you in the next one.